It's possible, but I think that if it is postponed to next year, it's only going to be until the January FOMC meeting. I think the Fed has made it reasonably clear that it sees improving economic data, and its objective is to have quantitative easing, at least of treasuries, tapered down to zero by the middle of 2014. I think that we are going to see increased pressure on emerging market currencies, particularly Indonesian rupiah and Indian rupee. I think that is likely to intensify again ahead of FOMC meetings, but I would also emphasize that there is more to just EM liquidity than Fed policy. In particular, I would expect improving data out of Europe to cause fund managers to rotate out of decorrelated economies, such as India and Indonesia, and into more correlated ones. So I would expect pressure on Indian rupee and Indonesian rupiah particularly, simply as a result of stronger European growth. I think equity markets rarely respond well to the start of an interest rate cycle or a monetary policy cycle. However, for most emerging Asian economies, I would emphasize that accelerating world trade growth is a bigger positive than higher rates are a negative. So that doesn't mean that markets won't react negatively to higher rates, but it means that they will quite quickly refocus on growth and refocus on an improving cyclical outlook. Certainly, I would expect developed economy equity markets to be well supported. I think in particular we'll continue to see improved performance out of Europe. However, emerging markets with large export sectors will accelerate faster than the acceleration we expect in either the US or Europe. So I think we are going to see an increasing differentiation within EMs between those that are decorrelated from world trade and those that are driven much more by exports to the West. Those that are driven by exports to the West are likely to outperform.